Your bank is lying to you right now. And the worst part, they're doing it legally. Check your savings account balance. See those numbers? They're growing, right? It's a few cents here, a few dollars there from interest. Your account statement shows progress, growth, safety. But here's what they're not telling you. While those numbers climb higher, the actual purchasing power of your money is collapsing. That interest rate they're paying you 1%, maybe 2%, if you're lucky, is a smokescreen. Because while your savings grow by 2%, the real cost of living is rising by 7, 8, even 10% in some years. You're not building wealth in that bank account. You're watching it evaporate in slow motion. Today I'm showing you 6 asset classes the wealthy use to escape this trap. Assets that don't just preserve wealth but actually grow it while everyone else's money burns. This isn't theory. This is the playbook. Let's break it down. First, you need to understand exactly how banks are robbing you in plain sight. When you deposit money into a savings account, the bank promises you safety and returns. You get insurance from the FDIC, you get interest payments, and you get the psychological comfort of seeing your balance increase month after month. But here's the mechanism they don't explain. That interest rate is almost always lower than the real inflation rate. Not the official government inflation number, the actual lived experience of rising costs. Let's use real numbers. In 2021 and 2022, average savings accounts paid around 0.3% interest. Meanwhile, inflation hit 9%, the highest in 40 years. That means if you had $10,000 in the bank, you earned $30 in interest, but lost $900 in purchasing power. Your $10,000 could now buy what $9,100 bought the year before. The bank gave you $30 and charged you $900 in invisible fees through inflation, and this isn't a recent phenomenon. This has been happening for decades. The game is designed this way. Banks take your deposits, lend them out at much higher rates, pocket the difference, and give you just enough interest to make you think your money is safe. It's not safe. It's dying slowly. So what do you do instead? Let's get into the alternatives, starting with the oldest form of real money humanity has ever known. Gold, silver, platinum. These aren't just shiny objects. They're the only forms of money that have survived every economic collapse, every currency crisis, every empire's fall throughout human history. Here's why they work. Scarcity. You can't print gold. You can't create platinum out of thin air. Governments can't legislate silver into existence. These metals exist in finite quantities, and extracting them from the earth requires real resources, labor, energy, time. This makes them the perfect inflation hedge. When central banks print trillions of dollars, the value of each dollar drops. But the value of gold relative to goods and services remains stable or rises. Look at the numbers. In 1950, an ounce of gold cost around $40 when the gold standard still existed. By 1971, when Nixon severed the dollar's link to gold, it was $35 per ounce. Today, over $2,000 per ounce. That's some forecasts. Project Gold hitting $10,000 by 2030. That's not gold becoming more valuable. That's the dollar becoming less valuable. And gold simply reflecting that reality. But here's what stops most people. They think investing in precious metals means buying physical bars and storing them in a vault somewhere. That's one option, but not the only one. Gold ETFs, exchange-traded funds, allow you to gain exposure to gold prices without ever touching physical metal. You buy shares in a fund that holds gold, and the share price tracks gold's market value. It's liquid, it's accessible, and you can start with as little as the price of a single share. Silver works the same way. And here's the bonus. Silver has industrial utility. It's used in electronics, solar panels, medical equipment, and water purification. As technology advances and green energy expands, silver demand increases, driving prices up independently of its role as a monetary metal. Platinum and palladium follow similar patterns, with heavy use in automotive catalytic converters and industrial applications. The wealthy don't keep all their money in precious metals, but they always keep some. It's insurance against currency collapse. And in a world where governments can't stop printing money, that insurance becomes more valuable every single day. Now let's talk about the raw materials that power modern civilization: commodities like copper, cobalt, nickel, lithium, and rare earth elements. These aren't just investments, they're bets on the future structure of the global economy. And right now, that future is electric. Take cobalt. In 2012, cobalt costs around $20,000 per ton. By 2022, it hit $40,000 per ton, a 100% increase in just 10 years. Why? Because cobalt is essential for lithium-ion batteries, which power everything from smartphones to electric vehicles. As the world transitions away from fossil fuels, demand for battery metals is exploding. Tesla alone plans to produce 20 million vehicles per year by 2030. Each electric vehicle requires dramatically more copper, nickel, and cobalt than a traditional car. This isn't speculative. It is infrastructure-level demand that will persist for decades. Lithium is another example. The price of lithium carbonate has increased over 500% since 2020. Governments worldwide are mandating electric vehicle adoption, which means lithium demand will continue surging. Copper is even more fundamental. It's used in electrical wiring, construction, electronics, and renewable energy infrastructure. As electrification expands globally, copper becomes increasingly indispensable. Some analysts project copper deficits, meaning demand will outstrip supply within the next 5 years. Now here's the practical question. How do you invest in physical commodities without buying tons of metal and finding warehouse space? Mining stocks. When you buy shares in companies like Rio Tinto, BHP, or Freeport-McMoRan, you're gaining exposure to commodity price movements. When copper prices rise, mining company profits rise, and stock prices follow. Commodity ETFs are another option. Funds that track commodity indices allow you to invest in a diversified basket of raw materials without picking individual companies. Futures contracts are more advanced. Essentially, you're betting on future commodity prices. These are higher risk but offer leveraged exposure. The point is this: as long as human civilization requires energy, infrastructure, and technology, industrial commodities will hold value. And unlike fiat currency, you can't create copper or lithium with a printing press. Here's a reality most people ignore. Not all currencies are equally worthless. Yes, every modern currency is fiat backed by nothing but government promises. But some governments are far more stable, disciplined, and trustworthy than others. That difference creates opportunities. The Swiss franc is the classic example. Switzerland has a centuries-long tradition of political neutrality, banking secrecy, and conservative monetary policy. The Swiss National Bank maintains strict controls over currency supply, and Switzerland's economy is highly diversified and stable. During every major financial crisis, 2008, the Eurozone debt crisis, COVID-19, investors flee to the Swiss franc. Why? Because it's perceived as the safest fiat currency in the world. In early 2023, one Swiss franc was worth $1.10 US. That means if you held Swiss francs instead of dollars during periods of dollar weakness, your purchasing power increased significantly. But Switzerland isn't the only option. Singapore dollar has similar characteristics, backed by a stable, well-managed economy with strong rule of law. The Norwegian krone benefits from Norway's massive sovereign wealth fund, built from oil revenues and invested globally. Even the Chinese yuan offers diversification benefits, especially as China's economy continues expanding its global influence through trade agreements and currency swap arrangements. Now, most people can't just open a Swiss bank account, but currency ETFs make this accessible. You can buy funds that hold foreign currencies and gain exposure to currency movements without needing offshore accounts. Forex trading platforms allow even small investors to trade currencies with as little as $100. The key is understanding that currency diversification protects you from the decline of any single currency if you live in a country with unstable monetary policy. This isn't about speculation. It's about not putting all your eggs in one currency basket. Let's address the elephant in the room: government bonds. Yes, we just spent this entire video explaining how fiat currency is backed by nothing. And yes, government bonds are denominated in that same fiat currency. So why would you invest in them? Because of one critical principle: governments are the last entities to default. Before a government fails, businesses fail, individuals fail, and entire economic sectors collapse. A government default represents total systemic failure. Stable governments, the United States, Germany, Japan, the United Kingdom, have never defaulted on their debt ever, even when facing massive crises. These governments find ways to honor their obligations, whether through austerity, tax increases, or monetary expansion. U.S. Treasury bonds are considered the safest investment in the world. Why? because they're backed by the full faith and credit of the most powerful economy in human history. The US government can tax the wealthiest population on Earth, and in extremis, the Federal Reserve can print dollars to service debt. This makes treasuries a better store of value than cash in a savings account because they pay higher interest rates and carry the same governmental backing. Treasury bills, notes, and bonds offer different time horizons. Bills mature in under a year. Notes mature in 2 to 10 years. Bonds mature in 20 to 30 years. Longer maturities generally pay higher interest rates. And here's the key. You can buy treasuries directly from the US government through treasurydirect.gov, avoiding broker fees entirely. But this is critical. Only invest in bonds from stable governments with investment-grade credit ratings. Remember Greece in 2009? The government nearly collapsed under debt, requiring massive bailouts from the IMF and European Central Bank. Greek bondholders lost fortunes. Government bonds are safe, but only if the government itself is safe. Now we get to the most tangible asset on this list: real estate. Land is unique. Accountants classify it as a non-depreciable asset for a simple reason: they're not making any more of it. Land is finite. And as the human population grows and cities expand, demand for land increases continuously. The numbers prove this. According to Bloomberg, US housing prices tripled between 1992 and 2020, despite the catastrophic 2008 housing crash. Even after the worst real estate collapse in modern history, prices recovered and surged past previous highs. Real estate serves multiple purposes simultaneously. It's a place to live, a source of rental income, and an inflation-resistant store of value. When currency loses purchasing power, real estate prices rise accordingly because the underlying asset hasn't changed. Only the currency measuring it has weakened. But here's where most people get stuck. They think real estate investing means saving for decades to buy a house. That's one path, but it's not the only one. REITs real estate investment trusts allow you to invest in real estate with the price of a single share. REITs own and operate income-producing properties, apartment buildings, shopping centers, office towers, warehouses, healthcare facilities. When you buy REIT shares, you own a portion of those properties. And REITs are required by law to distribute 90% of their taxable income as dividends to shareholders. This means you get both price appreciation and regular income without ever dealing with tenants, maintenance, or property management. Alternatively, you can finance rental properties with mortgages. The rent pays the mortgage, and you build equity over time while tenants cover your costs. This is leveraged real estate investing, and it's how many people build substantial wealth, starting with a relatively small down payment. The point is this: real estate isn't just for the wealthy. It's accessible at nearly every income level if you know the right vehicles. So here's what we've covered. Precious metals that hold value when currencies collapse. Industrial commodities that power the future economy. Safe haven currencies that protect against monetary instability. Government bonds backed by sovereign strength. And real estate, the tangible, finite asset that never goes away. Your bank account isn't protecting you. It's a slow leak, draining your wealth every single day. The wealthy understand this. That's why they diversify into real assets. That's why they don't keep cash sitting idle. And that's why their wealth compounds while everyone else's evaporates. If this video opened your eyes to how the system really works, subscribe and hit the notification bell because there's a lot more they're not telling you. Drop a comment and let me know which of these 6 asset classes are you investing in first. Next video, we're exposing how central banks profit every time inflation destroys your savings. You won't want to miss it. Thanks for watching. And remember, the best way to fight financial erosion is to stop pretending your bank account is safe.